Hey, Archie, what would be a really fun topic that we could talk about today?
Well, Rob, how about bonds?
Weekly wisdom to help you retire and stay that way. This is Last Paycheck.
Welcome back to Last Paycheck Podcast, brought to you by Hoxton Planning and Management. We're your hosts, CFP professionals, Archie Hoxton and Rob Hoxton. And today, we're going to be talking about bonds. Now, we a few episodes ago did sort of an interesting and fun facts about stocks. Today, it would naturally follow that we would do a fun and interesting facts about bonds. Now, I will say most people don't find bonds to be fun and interesting. I would say we think they're pretty fun and interesting, and hopefully some of these facts will help you understand if you're investing in bonds, which most of us have some amount in bonds, kind of understand better what you're investing in, why you're investing in it, what kind of role they play in the world, and also in a portfolio. So, yeah.
Archie, I've heard it. People say that learning about bonds is kind of like watching the paint dry. You know, it's just not that exciting, but it's really important. And when you have a period of time where stocks have performed so well for 3 years, and that was preceded by a period of time when bonds didn't perform very well,
Right.
Quite badly, in fact. We find that nobody really wants to talk about bonds, but it's really important, particularly if you're close to retired or you are retired and you're dependent upon income and portfolio stability. Brushing up on bond facts and fun facts about bonds, I think is pretty important.
Yeah. I think the best place to start here, though, is just a refresher on what bonds are. So, bonds are at their core are pretty simple. If you buy a bond, you are lending your money to the entity that issued the bond. That's usually a government or a corporation or a municipality. If they want to raise capital and they want to borrow money to do it, they go out into the capital markets, the world of investors, and issue bonds. And if you buy it, you're lending that money. You'll get interest for it, and then you'll receive your principal back at the end of the term when the bond matures. So that's kind of the high level. The what makes bonds unique from other types of loans is that they're traded. They're tradable. Yeah. So kind of like if you go and get a mortgage and the bank lends you money, sometimes you'll notice that all of a sudden your statements have a different institution at the top. And the bank has actually sold your mortgage to another lender or to a different bank. Well, with bonds, everybody can do that. If you lend your money, you can then sell that to someone else who wants to collect the interest on it, and they'll give you a certain price back for it. And that may be, well, that depends on a lot of factors, what they pay for it. But yeah.
Another interesting difference or factor with investing in bonds is because it is a loan, the borrower's ability to pay that loan back is super important, right?
Right.
So, if Uncle Charlie asks you to loan him some money and you agree to do it, you might be inclined to charge a really high interest rate because he's kind of, not very reliable. Well, the same is true if you're lending money to a borrower or to a borrower, like the issuer of the bond is maybe a corporation that has had some financial trouble, or maybe it's issued by a country that's, had some financial issues. So, the credit quality of that investment is really important. So that's one of the things that comes into play because it is a loan.
Yeah, absolutely. So that probably covers the basics of bonds, what they are, how they function, and the purpose they serve. But I think one of the most interesting things about the bond market is the size of the bond market, just the sheer scale. So I think it's probably common for people to assume that, most people don't really think about, the scale and size of the bond market. You might assume that the stock market is one of the largest investment opportunities as far as what the collective value of publicly traded stocks are worth if you put them all together. The bond market's actually quite a bit larger than the stock market. In fact, while the stock market is around 126 to 127 trillion in total market capitalization, that's the value of all the public stocks put together, the bond market is 145 trillion. So there's $145 trillion in outstanding public debt issued through bonds. That's
and the United States is the largest issuer of that debt.
It is,
which is not necessarily a good thing, but it's certainly true.
58 trillion of that 145 is in the United States.
Yeah,
that's governments, corporations, municipalities. So, yeah, it's huge.
People don't really think about bonds that much when they think about investing. If you're watching the news, or maybe you've got CNBC on your iPhone, the first thing that pops up is, what is the Dow Jones Industrial Average done? What has the S&P 500 done? What has the NASDAQ done? If you dig into the app, you can see what bonds have done, whether it be treasuries or the aggregate bond index. And when you're watching the news, if you watch the evening news, they never mention bonds at all.
Yeah.
And yet what's happening with bonds can be as much or more consequential as an indicator than what's happening with stocks.
Yeah, I think it's fair to say that it's probably more important what's going on in the bond market. This is the global debt. It's, how governments issue debt is through bonds. So, and it's probably the most important way that various entities raise capital for big projects. You may, if you follow what's going on in your local area, once in a while, you may notice, your municipality may decide they want to undertake some large project, and so they issue bonds for it.
Hospital, university, dorms, things like that.
Yeah. All these things are funded through bonds. The government spending, government investment into the private sector happens through bonds. If a business wants to build a factory, they're issuing bonds oftentimes if they're a publicly traded company. So
why, Archie, why is it important that we talk about bonds as potentially a part of a diversified portfolio for someone close to retiring or retired?
There's a few reasons. So bonds are less volatile than stocks. And when they have a bad year, it's not nearly as bad as when stocks have a bad year. And it comes to the difference of what they are, right? With a bond, as long as the credit quality hasn't changed of the issuer of the bond, the person who's borrowing the money, the entity who's borrowing the money, then your probability of getting your investment back at the end has remained about the same. So, ultimately you're lending out principal, you're getting interest, and you get your principal back. So there's a much less of sort of the up and down fluctuation of the principal value of the bond.
The caveat there is if you buy it in the secondary market and pay a premium for it,
right,
you're going to get the face value for the bond back. You may not get everything you put into it. So you got to be careful of that.
Right. So, and that gets into sort of the more complexity of the bond. The bond market is pretty complex. If you're just paying the face value, which means the actual amount that, it's typically denominated in increments of 1,000. So if you pay 1,000, you'll get 1,000 back. If this bond is in high demand and you pay 1,100, you'll get 1,000 back. Once you incorporate the interest into it, you may still make more than if you hadn't done it at all. But you have to incorporate these factors. This is where yield comes in. You'll often see yield to maturity. This is based on what you pay for the bond, and you account for the interest. How much what's your percentage rate of return over the life of the bond? So it's because there are these set parameters with bonds, you don't get as much volatility in them, and they are much safer.
They're not without volatility. I mean, sometimes when stocks go down, bonds will often behave independently, maybe not go down, and sometimes go up. Like in 2008, U.S. government bonds actually went up in value as the stock market really just cratered.
Yeah.
But that doesn't always happen. In 2022, when the Fed was raising interest rates so quickly to combat inflation, bonds suffered their worst bear market in maybe
Over a
modern
century.
history. Yeah, over a century. They didn't go down as much, broadly speaking, they didn't go down as much as stocks did that year, but they both went down.
Right.
So it's not without those types of risks. But
A multi-generational bear market in bonds is something, the loss is roughly equivalent to what the stock market goes through sometimes, every other year. I mean, it's like the extremes of bond volatility are, typical in stock market volatility. And sometimes you get this effect where they're not doing the same thing. When people are afraid of stocks, they're piling into bonds. So 2008 was an example. The early 2000s with the dot-com bubble, another example of where bonds did well and offset some of the volatility in the stock market. 2022, again, one of the worst years we've had in a long time.
right.
Here's another interesting fact that I think was interesting. I remember this happening. So in 2020. So in 2020, when
Think COVID.
The economy was essentially shutting down. It was like businesses were not able to do business as they normally would due to the restrictions around COVID. And what you had was a period of easy money where interest rates were slashed really, really low. Lots of cash was put out into the market and into the economy.
Lots of fear.
Stock market in like 3 weeks lost 35%.
Yep.
And so there was a high demand for bonds. Bond interest rates were really, really, really low. So there was a period of time where there were actually trillions of dollars worth of bonds that were paying a negative yield. Now, they weren't issued at a negative interest rate. They were issued at really, really low interest rates. But the price of the bond got bid up to where they weren't actually a positive investment from start to finish.
Yeah, so your yield to maturity was a negative number.
Yeah, you had to pay such a high premium that even the interest you got back didn't recover your full investment. And so there was this period of time where investors who wanted to lend their money were paying the borrower to borrow their money.
Yeah.
It didn't work exactly like that, but that was the basic concept. So, once in a while that sort of thing happens, and that was a situation of great fear and of extreme, sort of easy money practices with central banks, and sort of created a weird perfect storm.
Archie, you came up with a couple of, we've kind of saved these for the last, but when we talk about fun facts, there are some pretty cool things that you uncovered about bonds that I didn't know, about the existence of some very unusual bonds. You want to touch on those?
So in bonds, you have varying lengths of time. Like
maturity.
You can get, for example, you can get a 15-year mortgage, you can get a 30-year mortgage. Now you may be able to get a 50-year mortgage. So you have these varying lengths of time that you can borrow money. It's the same concept in bonds. You can have a very, very, very short-term debt. It's a month or a few months, 5 years, 10, 15, 20, 30 years. There are bonds that go a lot longer than that. There are century bonds that are issued for 100 years.
Yeah, who issues century bonds? I mean, none of us would be around to collect the principal from that bond if we bought one of those.
Right. So, you can imagine, you may have like sovereign wealth funds, pensions, huge institutional investors that may buy these kind of bonds. But Mexico, Austria, Argentina, and Ireland, and several other countries.
Mexico and Argentina. So if you're going to buy a bond for 100 years, you have to feel pretty good that over the next 100 years that issuer's ability to pay you will continue to be strong. Argentina and Mexico, that seems like risk. I mean, I'd have to get a really high interest rate for that.
Yeah. Well, and also, you're going to experience a lot more volatility in a bond like that as interest rates change, depending on what your interest rate is on a 100-year bond. You could experience some pretty wide swings in the principal value. But, those are available. What's even crazier?
Do they ever go longer than 100 years?
Well, there is a bond that is the oldest bond in existence. It was issued in 1624 by the Dutch Water Authority. They were, at the time, raising money to repair dikes. And they issued these bonds, and they were issued in perpetuity. And so they're going strong for over 400 years now. They pay 2.5% interest. If you own it, the interest payment is like 15 euros. So, I mean, it's pretty interesting that it's amazing to me that you would issue a bond like that.
It makes me think of, everybody, lots of people have these Series EE bonds that they were given. For a long time, it was popular to buy them for babies.
Yeah.
And you give them to a baby, and then in 15 or 20 years, they mature. But there are people, and myself included, who own these things, and they're such a pain to redeem that I could picture having some of those bonds 70 years.
I'm sure that there are bonds those specifically that will last that long.
Yeah.
But
it's like some Dutch person forgot to redeem their bond, and now it's owned by their great grandson, and it's
I like to think that the Water Authority just forgot to put when it matures, and then signed it, collected the proceeds of the loan, and then the loan holders were like, I guess you're going to pay me forever,
Yeah, it's like there's no maturity on this loan.
Yeah.
That guy had to have been fired, don't you think?
Yeah, I think so. Yeah, I thought that was kind of interesting. And there's lots more about the bond market. It's complex. It's enormous. It is, in a lot of ways, the plumbing and one of the most important aspects of our capital markets. It's one of the most important ways that capital flows, that things get done, that projects are accomplished by governments and businesses. It's incredibly, incredibly important. So, and we as ordinary people get to benefit from that and from the interest and stability that bonds provide. So anyway, we hope this was as interesting to you as it is to us. If you have questions or you want to hear fun facts about some other aspect of financial planning or any other episode, leave us a comment. Make sure you subscribe to the channel, like the video, hit the bell for notifications, share it with your family and friends, and we'll look forward to seeing you next time.
You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.